This is Raymond. He is 71 years old. He has banked at the same branch for 32 years. On a Wednesday morning in February, Raymond walked into that branch and asked for $12,000 of his own money for a roof repair. His roof was leaking. Winter was coming. The teller looked at his account. The money was there, every dollar, and they froze it. Not because Raymond did something wrong, not because the money was suspicious, not because there was a scam, because Raymond is 71 years old. And in 2026, that is enough for your bank to legally lock your money and walk away. Raymond waited 19 days. His roof continued leaking. He missed 2 prescription refills. His electric bill went unpaid, and his power was cut off for 3 days in February. Raymond did not know this could happen to him. His bank never told him. Nobody told him. You are watching this video, so by the time this ends, you will know exactly what Raymond did not. And you will know exactly what to do so this never happens to you or anyone you love. Before we go any further, if you have a parent, a grandparent, or if you yourself are over 65, please hit subscribe and share this video. The people who need this most are the last people the bank will ever call to warn them. Help us reach them.
My name is Lexi. I cover the legal side of Clause and Coin. And what Dan just described is not a rare edge case. It is the direct and intended result of laws that changed in 2026. Laws that most seniors and their families have no idea exist. Here is the reality. For years, when a bank suspected a senior customer was being financially exploited, they could warn you, but they could not hold your money. If they delayed a legitimate transfer and turned out to be wrong, you could sue them. So in most cases, the money moved. The problem was that financial fraud against seniors exploded. Americans over the age of 60 lose $28.3 billion every single year to financial exploitation. That figure comes directly from AARP. 1 in 5 Americans over 65 has already been a victim, and only 1 in every 44 cases is ever reported, because most victims know the person who is stealing from them. A family member, a caregiver, someone already inside their life. So lawmakers acted. Banks were given more power to step in. And as of January 1st, 2026, more than half of all U.S. states have enacted what are called safe harbor laws. In plain language, here is what a safe harbor law does. If a bank reasonably believes an older customer is being financially exploited, the bank can freeze the transaction, hold the money, and delay your access. And you cannot sue them for doing it. They are fully legally protected. The legal term written into these laws is specified adult. And a specified adult means anyone 65 or older. That is the line. The day you turned 65, you entered a legal category that gives your bank authority over your money that they do not have over anyone younger. The intention behind these laws is not malicious. They were written to protect the grandmother who wired her life savings to a romance scammer, the retiree who handed over his bank details to someone pretending to be from Medicare. That problem is real. Those losses are real. But here is the gap nobody warned you about. Banks do not review your account with a human being carefully examining your life. They built automated systems, in many cases now powered by artificial intelligence, that monitor your spending patterns, learn your financial behavior, and flag anything that breaks the pattern. That system cannot tell the difference between a scam and your normal life. And when it gets it wrong, which it does constantly, you are the one sitting outside the bank with no access to your own savings. Today, Dan and I are going to show you 9 specific triggers that can cause your bank to freeze your account right now in 2026. And then I am going to give you 7 layers of protection, starting with 1 free phone call you can make this afternoon that makes you nearly impossible to freeze. Your bank will never volunteer this information. Let us begin. Before we get to the triggers, you need to understand the 2 laws at the center of this. Because knowing the law is the first layer of your protection. The 2 rules. The first is FINRA Rule 2165. FINRA, the Financial Industry Regulatory Authority, governs broker-dealers, investment firms, and most accounts where Americans hold retirement savings. In 2018, FINRA passed Rule 2165, the first uniform national standard for placing temporary holds on accounts belonging to specified adults. Anyone 65 or older. Rule 2165 gives any FINRA-registered firm, your brokerage, your IRA custodian, your investment advisor, the legal right to place a temporary hold on a transaction or disbursement from your account if they have what the rule calls reasonable belief that financial exploitation has occurred, is occurring, has been attempted, or will be attempted. Will be attempted. That means they can freeze your account based on what they think might happen. Not what has happened, not what is happening, what they believe might happen. How long can they freeze it? The initial hold under Rule 2165 is 15 business days, not calendar days, business days. Weekends do not count. Federal holidays do not count. A freeze that starts Thursday before a long holiday weekend can stretch to 4 full calendar weeks. 4 weeks of direct deposits arriving that you cannot touch. 4 weeks of bills. 4 weeks of prescriptions. Your own money. Locked. And the bank owes you zero compensation for any of it. Rule 2165 was amended in 2022 to allow an additional 30 business day extension if the firm conducts an internal review and still believes exploitation is occurring. That brings the total to up to 55 business days. And in January 2026, FINRA issued Regulatory Notice 2602 proposing to extend the maximum hold period to 145 total business days, nearly 7 months, with 3 additional 30-day increments. If this proposal becomes law, and the direction is clear, your bank could legally lock you out of your own retirement savings for the better part of a year. While conducting an investigation, they are not legally required to share with you in any meaningful detail. Alongside FINRA Rule 2165, which governs investment accounts, more than 30 states have enacted or strengthened safe harbor laws for regular bank accounts as well. These laws grant banks legal immunity from lawsuits when they freeze an account in good faith. In states like Florida and Minnesota, these laws were strengthened specifically in 2026 to allow banks to report seniors to Adult Protective Services without your consent. Now you know the law. Let us talk about what triggers it. 9 specific triggers. Every single one of them is happening to real seniors with honest money in 2026. Trigger 1. Large withdrawal flag. Trigger 1. The large withdrawal flag. Your bank system has been quietly studying you. Every deposit, every withdrawal, every transfer. It has built a profile of what your financial life normally looks like. And the moment you step outside that pattern, the moment you ask for an amount that does not match your history, the system flags it. The number is not fixed. It is not $10,000 or $20,000. It is relative to you. If you normally withdraw $400 a month, asking for $3,000 can be enough to trigger a review. This is exactly what happened to Raymond. $12,000 for a roof repair. His typical monthly withdrawal, under $1,000. The AI flagged it in seconds. Raymond waited 19 days. What to do? Never walk into your bank cold with a large withdrawal request. Call 3 to 5 business days before and use these exact words. I am planning to withdraw amount on date for reason. I want this noted on my account record today. That one conversation puts a legitimate explanation on your file before the algorithm has the chance to invent a suspicious one. Announced money does not look like stolen money. Surprise money does. Trigger 2. The behavior change trap. Your bank does not just track your transactions. It tracks how you bank. The time of day you log in, the device you use, the speed at which you type. Some systems track touchscreen pressure patterns on mobile devices. Any change in that behavior, even a completely innocent one, can flag your account. Specific examples that trigger reviews. Logging in from a new phone, even one your child gave you as a birthday gift. Using Zelle or Venmo for the first time. Logging in from a different city when you are traveling. Accessing your account late at night when you normally bank in the morning. Sending money to someone new, even your own grandchild. None of these mean anything is wrong. All of them can freeze your account. What to do? Anytime something in your life genuinely changes, new phone, travel plans, new person you are sending money to, make a 2-minute call to your bank first. Use this language. I am getting a new phone this week and will be logging in from a new device. Or, I am traveling to Florida next month and will be accessing my account from there. You are writing your own explanation before the machine writes a worse one. Trigger 3. The structuring trap. And this one is a federal crime. I need you to pay close attention here because this is the trigger where good, honest, innocent people end up in serious legal trouble, not because they did anything wrong with their money, but because of the pattern of how they withdrew it. Here is the scenario. You have heard somewhere that withdrawing $10,000 or more triggers an automatic federal report. You do not want to deal with that. So you think, I will take out $9,000 today and $9,000 next week. Stay under the line, keep it simple. Do not ever do that. What you just described is a federal crime. It is called structuring, and it is prosecuted under 31 United States Code Section 5324. The law does not care that the money is 100% yours. It does not care that every dollar is completely legal. The act of breaking up withdrawals specifically to stay under the $10,000 reporting threshold is itself the crime, regardless of where the money came from. The IRS and FinCEN, the Financial Crimes Enforcement Network, have seized entire bank accounts from people who were never charged with any underlying crime. People whose money was completely honest. The Institute for Justice has documented dozens of these cases. What to do? If you need to withdraw a large amount, take it in one clean transaction. Let the federal report be filed. That report is called a currency transaction report. It goes to a federal database for honest money. Nothing happens. Nobody shows up. Nothing is investigated. The danger was never the report. The danger is the pattern that looks like you were trying to avoid it. One clean withdrawal, one routine form. Zero consequences for money that is yours. Trigger 4, the dormant account sweep. And this one steals money from seniors every single year in complete silence. You have an account you rarely touch. An old savings account you set aside years ago. A certificate of deposit you opened and left alone. A fund you built carefully and decided not to disturb. You are being responsible. You are being patient. The bank has a different word for that behavior. They call it abandoned. If there is no owner-initiated activity on an account for a period of time, in most states that window is 3 years, in some states as short as 1 year, the bank can legally declare the account dormant and transfer your money to the state government as what is called unclaimed property. Your money. Transferred to the state. Without your permission, without a phone call. Often without any notice you would actually notice. And here is the detail that makes this worse. Automatic activity does not count. Interest being credited to your account every month does not reset the dormancy clock. A recurring direct deposit, in many cases, does not count either. The clock resets only when you, the account owner, initiate a transaction. A login, a transfer, a withdrawal. Something that proves you are still there and still in control. There is currently over $77 billion in unclaimed property sitting in state government accounts across this country. Most of it belongs to people who have no idea it was taken. What to do? Every January, first week of the year, log into every account you own and make one small owner-initiated transaction. A $1 transfer in or out. 1 minute per account. That single action resets the dormancy clock for another full year. And if you want to check whether money has already been swept, go to missingmoney.com. It is the official multi-state unclaimed property database. Free to search, free to claim. You may find money you did not know was already gone. Trigger 5, the investigation freeze. Trigger 5, the investigation freeze, the silent lockout. When any of the previous triggers flags your account, the bank does not simply review it and move on. They freeze it. And what most seniors do not understand until they are standing at the teller window unable to access their own money is the structure of who placed the freeze and why the people right in front of you cannot help. Your account is flagged by an automated system. That flag is routed to a separate internal compliance department. That compliance department places the hold. And that department operates completely independently from the branch, from the customer service line, and from the teller in front of you. The teller did not place the freeze. They cannot lift it. The customer service representative on the phone did not place the freeze. They cannot lift it. The branch manager, in most cases, does not have access to the compliance department's hold system. They cannot lift it either. You are not given a direct number for the compliance department. At most major banks, you are not allowed to call them directly at all. Your direct deposits keep arriving. Your Social Security payment comes in. Your pension hits the account. Every dollar lands exactly where it is supposed to, and you cannot touch any of it. What to do? The moment you discover a freeze, Ask one specific question. Not, why is my account frozen? Not, can you fix this? Ask, which department placed this hold and what is the direct process to reach them? Get the answer in writing. Then request a manual review. Use those exact words, manual review. Automated holds at most institutions can be escalated to a human examiner when that phrase is specifically used. Trigger 6. The out-of-state and new account transfer block. This trigger surprises people who are doing something completely reasonable, moving their own money between their own accounts at two different institutions. Here is what the system sees. You are initiating a wire transfer to a bank it does not recognize. The destination account was opened less than 90 days ago. The transfer is going to a different state, and the amount is larger than your typical transaction history. To a human being who knows you, that is a completely normal financial move. To an algorithm that only knows patterns, those four factors together look exactly like what a scammer does with a victim's money. What to do? When you plan to move money to a new institution or newly opened account, do it in 3 stages. First, make a small test transfer of $500. Let it clear completely. Second, call both banks and tell them a larger transfer is coming. Get the name of the person you speak to at each institution. Third, make the full transfer. A planned, announced, expected transfer moves through cleanly. A large, sudden, first-time transfer is the one that gets stopped every time. Trigger 7. AI behavioral profiling. Trigger 7. AI behavioral profiling. Banks are no longer just watching what you do with your money. They are watching how you exist while you do it. As of 2026, all financial institutions are required to have automated behavioral monitoring systems in place. These AI systems analyze what the industry calls your financial heartbeat. What time you log in, how fast you type, where you shop, whether you are on a phone call while accessing your account. If you are on the phone while simultaneously using your banking app, a pattern consistent with tech support scams, the AI may block your transaction entirely. If you have never used Zelle and suddenly try to send $500, the system flags it as potentially coerced behavior. A senior who is simply learning new digital banking habits in 2026 looks identical to an exploitation victim to a system that cannot tell the difference. What to do? Use payment methods consistently. Introduce new methods with a small test transaction first. Log in regularly even when not transacting. Announce all pattern changes to your bank in advance. Trigger 8. The joint account removal flag. And this one is among the most unfair on this list, because it punishes seniors for making a completely legitimate, often emotionally painful, account change. When a senior removes a joint account holder, after a spouse passes away, after a divorce, after a family relationship changes, the bank's compliance system can flag it as a potential exploitation indicator. The logic the algorithm uses. Someone may be isolating this senior from a trusted person on their account. A widow removing her deceased husband's name from their joint savings account can trigger a compliance review. A senior removing an adult child from an account after a falling out can trigger a hold. The person is doing something completely normal, completely legal, and often emotionally difficult enough already, and the system treats it as suspicious. What to do? Anytime you plan to change the ownership structure of an account, bring documentation explaining the reason. A death certificate, a brief written statement. If possible, have your attorney send a short letter on letterhead confirming the change is voluntary and intentional. That documentation presented proactively gives the compliance system a legitimate explanation before it has the chance to manufacture a suspicious one. Trigger 9. Outdated KYC documentation. Trigger 9. Outdated KYC documentation. KYC. Know your customer. These regulations are being strictly enforced in 2026. Banks are auditing older accounts that were opened decades ago with minimal documentation. If your file is missing a current photo ID or proof of address, the system may automatically place a soft freeze on your account until you update it. You will not necessarily be told why. You may only discover the KYC hold when a transaction declines and you call to ask why. What to do? Contact every institution where you hold an account and confirm that your current photo ID and proof of address are on file. Update them if they are not. One visit or one phone call per institution. This prevents a soft freeze from triggering automatically on a decades-old account the bank is auditing for the first time. Trigger 9. Outdated KYC documentation. KYC, Know Your Customer. These regulations are being strictly enforced in 2026. Banks are auditing older accounts that were opened decades ago with minimal documentation. If your file is missing a current photo ID or proof of address, the system may automatically place a soft freeze on your account until you update it. You will not necessarily be told why. You may only discover the KYC hold when a transaction declines and you call to ask why. What to do? Contact every institution where you hold an account and confirm that your current photo ID and proof of address are on file. Update them if they are not. One visit or one phone call per institution. This prevents a soft freeze from triggering automatically on a decades-old account the bank is auditing for the first time.
Now let me give you the financial picture behind everything Lexi just explained. Because the scale of this problem is something most people cannot comprehend until they see the numbers. The scale. $28.3 billion. That is the amount stolen from Americans over the age of 60 every single year, according to AARP. Not an estimate, a documented figure. The average victim of elder financial exploitation loses $34,200. When the abuser is someone they know, the average loss jumps to $50,000. And the average overall victim loses $120,000. In 2024, Americans over 60 lost $4.8 billion to internet crime alone, according to the FBI. More than any other age group, by a significant margin. Who is stealing it? 72% of elder financial exploitation is perpetrated by someone the senior already knows. A family member, a caregiver, a close friend, someone already inside their life. And because the abuser is someone they love, 87.5% of these cases are never reported. 1 in every 44 cases. That is the reporting rate. Because seniors would rather lose the money than report the person they love. And for seniors on fixed incomes, even a legitimate protective freeze can trigger a cascade of consequences that have nothing to do with fraud. Missed rent payments, missed prescription refills, missed insurance premiums that cancel coverage, utility cutoffs, inability to pay for food. For a retiree living on Social Security, a 10-day freeze is not an inconvenience. It is a financial emergency. Nearly 1 million seniors in this country are currently skipping meals as a direct result of financial abuse. The system was designed to catch the scammer, but it cannot tell the difference between a scammer and your normal life. Which is exactly why you need what Lexi is about to give you, 7 layers of protection. Most seniors have 0 of these in place right now. By the time this video ends, you will have everything you need to build all 7. Starting today. Trusted Contact Person. Protection 1. The Trusted Contact Person. This is the single most powerful thing you can do right now, and it is completely free. Under FINRA Rule 4512, banks and brokerage firms are required to ask you for a trusted contact person, a secondary individual they can call to verify that a large transaction is legitimate. A trusted contact is not a joint owner. They cannot see your balance. They cannot access your money. They cannot make any decisions about your account. They are simply one person whose name and phone number you give the bank in advance. Here is why it changes everything. When the bank system flags your account, having a trusted contact on file gives them an alternative to a full freeze. Instead of locking everything down, they make one phone call. Your daughter confirms the withdrawal is for a roof repair. The freeze never happens. You never know it almost did. Having a trusted contact person can reduce a 15-day freeze to a 15-minute phone call. Call your bank today, not this week, today, and say these exact words. I would like to add a trusted contact person to my account. Can you walk me through the process? 5 minutes. Done. And tell your trusted contact about any large transactions you are planning, so if the bank calls them, they are ready with the right answer immediately.
Protection 2. The Advanced Announcement Protocol. Announced activity does not look like suspicious activity. That is the entire principle. The protocol for every situation. Large withdrawal. Call 3 to 5 business days ahead. Use the exact language from Trigger 1. New device or phone. Call the same day you start using it. Travel plans. Call before you leave. Sending money to someone new. Brief explanation call first. Large incoming transfer. Notify your bank before it arrives. And build a human relationship at your branch. Ask for one specific person by name. When your account gets flagged and there is a person at that branch who knows you, that human context can resolve in hours what an automated system would hold for weeks. Build that relationship before you need it, not after. Protection 3. A durable financial power of attorney, but the right version. Most seniors who have a power of attorney believe they are protected. Many of them are not. Because of one specific problem almost nobody warns them about. Banks reject generic powers of attorney constantly. A document downloaded from the internet, notarized at a copy shop, is turned away by bank legal departments more often than most people realize. Too old, wrong state language, missing specific provisions the institution requires. What you need is a POA that your specific bank will actually accept. Call your bank and ask this exact question. Does your institution have a preferred power of attorney form or specific language requirements for documents you will honor? Many major banks have their own form. Get it. Have your attorney build that language into your document. Then file a copy directly with your bank and confirm in writing that they have accepted it. A power of attorney that your bank rejects is the same as no power of attorney at all. And remember, a power of attorney is far safer than joint ownership. With a power of attorney, your money is protected from your agent's creditors. With joint ownership, it is not. Protection 4. The two-bank rule. Never allow one institution to control your entire financial access. If your primary account is frozen, a second account at a different bank or credit union means you are never completely cut off. You can still pay bills. You can still buy groceries. You can still fill prescriptions. The freeze becomes a serious inconvenience instead of a genuine emergency. Open a second account, a basic checking or savings account at a different institution. A local credit union works well because credit unions operate under a different regulatory structure and are often more flexible with senior customers. Keep 1 month of essential expenses in that account and leave it there. Do not use it for daily spending. It is your emergency access account, there specifically for the day your primary institution locks you out. For most seniors, 1 month of essential expenses is between $3,000 and $4,000. That amount sitting in a backup account is the difference between a crisis and a manageable problem. Protection 5. Know exactly what your rights are if your account is frozen. Under FINRA Rule 2165, the firm must notify you in writing within 2 business days of placing the freeze. If they do not, that is a violation of the rule. If your account is frozen, here is exactly what to do. 1. Request the written notification immediately. 2. Ask specifically which transaction triggered the hold. 3. Contact your trusted contact person immediately. 4. Tell the bank you have essential disbursements that must be permitted. Rule 2165 specifically requires that legitimate regular bill payments continue to go through even during a freeze. 5. Request a manual review. Use those exact words. 6. If the hold violates the rule, file a complaint at finra.org or contact your state's banking regulator. Protection 6. Actively manage your behavioral profile. Log into your accounts regularly, even when you are not making transactions. Consistent login activity signals that you are an active, engaged account holder. Notify your bank before making any transactions significantly larger than your historical average. Use payment methods consistently. Introduce new methods with a small transaction first. If you are planning to travel, notify your bank in advance. And update your identification documentation with every institution where you hold accounts. A current photo ID and proof of address on file prevents the KYC soft freeze from triggering automatically. Protection 7. Get your estate planning documents right before you need them. 3 documents every person approaching or over 65 should have in place. 1. A durable financial power of attorney, using your bank's specific accepted language. 2. A revocable living trust. Placing assets in a properly structured trust provides an additional layer of protection from both exploitation and unnecessary account freezes. 3. Current updated beneficiary designations on every account you own. Investment accounts, retirement accounts, and life insurance policies all pass directly to beneficiaries upon death, outside of probate, if the designations are up to date. Consult a qualified elder law attorney in your state to get these documents in place. The cost of proper legal planning now is a fraction of the cost of undoing a financial crisis later.
Let me bring us back to where we started. Raymond, 71 years old, 32 years at the same branch, $12,000 for a roof repair, 19 days frozen, roof leaking, prescriptions missed, power cut off for 3 days in February. Here is what breaks your heart when you know what we now know. If Raymond had called his bank 3 days before that Wednesday morning, if he had said, "I am planning to withdraw $12,000 on Wednesday for a roof repair. Please note that on my account record today," the transaction would have gone through without a second look. If Raymond had named his daughter as his trusted contact person, one phone call would have confirmed everything the bank needed to know. 19 days, canceled contractor, missed prescriptions, 3 days without electricity in winter. All of it, prevented by 2 phone calls that together would have taken less than 10 minutes. Raymond did not know these options existed. His bank never told him. Nobody told him.
I want to say something that I think is genuinely important. These laws were not written against you. The safe harbor legislation, the automated monitoring systems, the compliance holds, they exist because real criminals are stealing billions of dollars every year from real seniors who worked their entire lives for that money. The system was built to protect you. The problem is that the system cannot tell the difference between a scam and your normal life. And the gap between what the system was designed to do and what it is actually doing to innocent people, that is where your retirement money is at risk. That gap does not close on its own. The bank will not close it for you. The law does not require them to. The only person who closes that gap is you. By building the protection layers before the system decides you need protecting from yourself.
If this video gave you even one thing you did not know before, hit like right now. It takes 1 second. And it tells YouTube to show this video to the millions of people who need to see it before this affects their family.
Subscribe to Claws and Coin. I cover the legal side. Dan covers the money side. Together, we make sure the system never catches you off guard. And send this video to one person you know who is over 65. Your parent, your neighbor, your closest friend from work. You are not sharing a video. You may be saving them 19 days of frozen accounts, canceled appointments, and unpaid bills. The bank is not going to call them and explain any of this. You might be the only one who does. New video every Tuesday, Thursday, and Saturday. We will see you in the next one.